Welcome to the Invest Well Show. I'm your host, Michael Wall. Listen, it's been a minute since we've done a show, but I want to get back into the rhythm and routine of providing value to you around your wealth. Listen, there's a lot of chaos and challenges that are happening in our world today. A ton. So many, probably more than I've ever seen. We're living in a 24-hour news cycle in a way that is just monotonous and mundane and overwhelming, quite honestly, to many, many people. And so the question is, how do you navigate through all of that noise and make better financial decisions? And I think sometimes in life we can be in a place where we can find our investments or ourself just kind of doing what we've always done because that's what we think we should do. And I want to challenge you that you got to step back and kind of think a little bit differently in this season. So I want to talk this show about the idea of investing through an election. You know, here we are as I'm shooting this right now. It's kind of middle of October. We got the election coming up here. Obviously, it's a big election, the presidential election. And there's a lot at stake. I don't want to get political in the conversation here, but I do want to talk about what has some of the history shown us in relation to investing through an election. So let's talk about that. I'm going to pull a chart up on screen in just a minute. But before I do that, I want to give a shout out to the sponsors of the show. I always wear the shirt, Walt Private Wealth. They've done a great job, great team over there helping families, wealthier families, a couple $1 million or more, protect, grow, and reduce taxes on their wealth. So you got questions, you got concerns, you want to reduce taxes, you want to maximize your wealth, or go down that path, reach out to them, head over to leanonthewall.com. All right, let's jump in. So I'm going to pull a chart up on screen to get started. And as you're looking at this chart, you're seeing a couple things here. The first thing that you're seeing is all the way to the left of the chart, we see it starts in 1929, and then it goes all the way to 2023. It gives us a little bit of an idea of what has happened through previous election cycles. And look at this. If you take a look at the gains and negatives along the way, the blue obviously is for Democrat, and the red is for Republican, and we can see kind of what's happened. So we say all the way back from 1929, that with Hoover, when he was elected, the markets went down 27%. Then we got the next election where it was up 26%. And we had Roosevelt down 11%. Now we fast forward to kind of more current times. We say, let's take a look at what happened with Reagan as an example. Even before Reagan, I think this is important to point out. Remember, a lot of people have talked about Carter, right? And his economy and inflation and all of these things that happened. What's interesting is that during that process, it went up 6%. The markets did, even though there was bad economies and challenging times. Now, obviously, people got excited when Reagan came in. It was a little bit more of an entrepreneurial process. We want to highlight that. Look at that. There's two seasons there for Reagan where it was +5 and +14. Now, if we go all the way to where we are today, we got Trump and then Biden. Obviously, Trump, when he was elected the first time, it went up 14% that year, and then up 8% when Biden was elected. Now, I want to talk about current and now and what should we expect, because when you take a look at the past, there's really no clear winner per se, as far as, you know, folks that say, well, if a Republican is elected, this is what happens with the markets. And others may say, well, if a Democrat is elected, this is what happens with the markets. The reality of it is there's no real clear winner. What we do know that is in the course of since 1929, there's literally been, 3, 4, 5 negative markets out of all of them. So will that continue? Obviously, the averages, the law of averages here in the past, the history, kind of shares or says the fact that the markets have a much higher chance of being up in an election year than they have being down. Now, obviously, as I'm shooting this right now, the markets are up for the year, so we have to understand that. But the question is, where do we go afterwards? What happens with your investments afterwards? What happens with your portfolio after the election, and how do you prepare for that? I kind of look at this almost like, maybe you've heard it said before, when you own a stock, oftentimes there's a little bit of a controversy or challenge or worry or fear or concern if you hold that stock through earnings, because you don't know if earnings are going to be strong or negative. If earnings are strong, obviously the stock oftentimes go up. If earnings are negative or it misses earnings, so to speak, oftentimes the stock can go down. And to me, when you look at investing around an election season, especially in where we are today, because I think some factors that we have to think about today that were just not the same years ago is we have significant debt today, trillions and trillions of dollars of national debt. All you got to do is head over to usdebtclock.org. We're going to bring that up right now. I want to show that to you because I think this is so important. When you take a look at the debt of the country and you take a look at the reality of where we are, and you take a look at what's necessary to get out of debt in a way that, we realize, quite honestly, you and I, the consumers, are the ones that are going to pay this bill. I think that's important to understand. The U.S. national debt, if you look in your upper left, is $35 trillion. Now come back to the camera for a minute. Let's talk about that, everybody. Have a little a fireside chat. That's a lot of debt. That's a serious problem. Now, if you go back to this chart, you'll see it right next to the U.S. national debt. It has the federal spending, it has the deficit, and then it has debt per citizen, and then debt per taxpayer, okay? Now, that's an important question because a lot of people say, well, hey, we need to have the wealthy pay more in taxes. Well, not everyone pays taxes, and I'm not going to spend too much time on this. I just want to kind of bring some of these things into the forefront because I think this gives us some context in the reality that where we are today is different than where we were years ago. I know the economy in the U.S. has had significant challenges that we've worked through. I'm a believer in the American economy. I'm a believer in the American citizen. I'm a believer in the American dream. But I think we have to realize that at the end of the day, where we are right now in relation to debt, let's pop that up again. You'll see upper left, $35.6 trillion. It runs on the regular. The debt literally is in a situation where it's gone up significantly. The U.S. federal debt, look at the GDP ratio there at the bottom of that box. The U.S. federal debt to GDP ratio in 1960, the federal debt to GDP is gross domestic product, what we're producing a year. It was 52.3% of the GDP. Now it's 124%. Listen, everyone, this is unsustainable. These are conversations that we've had for a long time. One of the great clients that we have at wearing my other hats at my financial firms, Wall Private Wealth, U.S. Private Wealth, is David Walker. He was the head of the federal, basically 3 federal departments for 10 years. He was the comptroller general, basically the top CPA in the country. Just so happens to be a client of our firm. We're blessed to have him as a client. But one of the things that he has talked about for years and years and years is fiscal responsibility. Now, what does that have to do with you and your investments? So let's talk about that fact. What this has to do with you and your investments is when there is chaos and controversy out there, eventually it affects you in here. Some of the paths that we've watched wealthy families take over the years is there's been bins, not a great word, don't use that, unless you're binge watching, I guess. But there's bins, I'll use it again, lots of monies moving off the sideline and moving into alternative quality stuff like real estate and private equity and other things like that. You've heard me say before, if you've watched my shows, there's literally 56, almost 57% less publicly traded stocks today than there were in 1996. What does that mean? That means that if you're in a place where your only game from the investment perspective is in the stock market, you're missing out on opportunity. All right, so what should you do with your portfolio? Well, first off, I think now is a great time. I think any time is a great time. But I think now is a great time where you literally need to step back, press pause, and ask yourself an honest question, whether you're managing your own money or whether someone else is helping you manage your money. I want to challenge you to put the friend card aside. I want to challenge you to think about your investments as a business. I want to challenge you when you look at your wealth to look at it as a company. And I want you to honestly answer this question. Over the last 10 or 15 years when the markets were negative, did you lose money? Yes or no? Short answer. If it was yes, and you may follow that up with, yes, I did lose money, but I came back and I made back what I lost. So really, technically, over time, I didn't lose money. That's not the question that I'm asking. The question I'm asking is, did you lose money in the year when the markets crashed? Now, I'm not saying that every investment is perfect because that's unrealistic. There's risk in everything. There's good and bad of everything. That's the reality of the story. But you have to ask yourself the question, if you are primarily invested in the market, if when the market goes up, you go up, and the market goes down, you go down, even if you have an advisor, the question is, what real control do you have over your investment structure in relation to different allocations that could potentially help you weather the storms potentially coming better? I think what we're going to see through this electionary period is there could be a lot of excitement and there could be a lot of negative. But what we know for sure is anytime there's uncertainty, there's a lack of direction. That's so important. And so right now, I think is a great time to step back and look at your portfolio. The other thing that I would challenge you to think about is, how are your investments aligned or not aligned with investment structure or investments in general that have performed well, that have been off market over the years? You know, the Harvard and Yale endowment models, which is where our trademark process at one of my companies kind of started to come from, the initial incubator of the research. And what I've realized over the years is they have continually eked out quality double-digit returns. The reason is because they have an appreciation and an understanding of well-vetted, quality off-market investment structures. Structures that are not too big. Structures that are very focused in nature. Investment structures that give the opportunity to not experience the ebbs and flows of the market. That creates a lot of stability when you're looking at your investments. And I'm not talking about the guy out there just selling annuities and trying to tell you to go buy an income rider. I'm not suggesting that either. Personally, I think those types of riders are the wrong approach for families that have a fair amount of wealth. Now, I'm not saying that you should and shouldn't get it. I'm saying it's important to step back and say, okay, let's think about this. We need to reevaluate our current investments. We need to look at off-market strategy and structure, and we need to think about, are there ways that we could potentially be utilizing some of the investment structure that wealthy families have used and are using to help them fare well in any economy, and how do we get there? Again, if anything, this is my challenge to you is to stop the deer in the headlights and actually step back and say, okay, let's revisit what we talked about. We talked about the blue and the red. Let's get our mind off of that, whether it's a Democrat or Republican. Forget that, because there's not really any proof in the pudding as far as what markets will or won't do as far as moving forward. Number two, let's look at the reality of what the debt is on the country. That's real math. We know it's genuine. We know it's real. And let's think about, number three, the reality of who's going to pay for that debt. Well, we are. And if you got a couple $1 million or more out there, you're going to be in a place where you're probably going to be paying more. So it's important to say, how do I change and alter my investment structure to give me opportunity to things that are not just on market, but things that are off market, maybe have elements of immunity to the ebbs and flows daily of the stock market, number one. Number two, what are some strategies that I should be looking at implementing in relation to taxes? How do I reduce that risk? In my opinion, one of the biggest risks with your investment or your income, if you're making a couple $1 million a year, is not the market or other investments that you're investing in. I think what comes right alongside and is as equally as important of a risk is taxes. Now, I'm not saying you shouldn't pay taxes, but what I'm saying is you want to make sure that you're maximizing all of the strategy that you need to maximize. And that's exactly why you got questions. Head over to leanonthewall.com, the team that I told you about at the beginning. They're a great team, soup to nuts. They can file returns. There's some qualifications there, but head over, check them out. And listen, take some time to slow down and think about what you're doing in life. Just because you have a friend, just because you've been doing it the same way, doesn't mean you should keep doing it the same way. Slow down, think about it, get off market, lower your risk to the benefit and the advantageous opportunity that you can. Be blessed, have fun, we'll talk soon.